Somewhere right now, a company is calculating the exact odds of your house burning down, the exact odds of your car crashing, the exact odds of you dying this year, this decade, this century. They're not guessing. They have a number, a precise, calculated number. And based on that number, they're willing to make you a bet. They bet that disaster won't happen to you. You bet that it will. Whoever's right keeps the money. This bet has a name. We call it insurance. It sounds boring. Paperwork, premiums, fine print nobody reads. But underneath that boredom is one of the strangest, most powerful ideas humans have ever invented, an industry built entirely on betting against your own bad luck that has quietly grown into a force so large it can prop up governments, sink economies, and decide who lives comfortably and who doesn't. This is the story of how a handful of merchants trying not to lose everything at sea built a machine that now touches nearly every dollar on Earth. This is the history of insurance. To understand insurance, you have to go back nearly 4,000 years to the merchants of ancient Babylon. Trade back then was terrifying. A merchant could load a caravan with goods, send it across the desert, and never see it again. Stolen by bandits, lost to weather, gone. So merchants came up with a workaround. If you wanted to borrow money to fund a shipment, you could take out a loan, but with a catch. If the shipment was lost or stolen, you didn't have to pay the loan back. If it arrived safely, you paid back the loan plus extra, a premium essentially for the risk the lender took on. This idea got written into law under Hammurabi's code around 1750 BCE. It wasn't called insurance yet, but the DNA was already there. Pay a little now to protect yourself from losing everything later. Somebody, somewhere, had figured out how to turn fear itself into a financial product. Fast forward 1,000 years, and the Romans took this idea and refined it. Roman merchant guilds created burial societies. Members paid small regular dues, and in exchange, if a member died, the society covered funeral costs and supported the family left behind. This was the first real appearance of something we'd recognize today, pooled risk. Instead of one person betting against one disaster, a group of people pooled small amounts of money so that when disaster hit any one of them, the group could absorb the loss. This is the core mechanical trick that makes insurance work, and it's remained unchanged for 2,000 years. No individual can predict their own disaster, but across thousands of people, disaster becomes statistically predictable. Someone in the group will always have a fire, a shipwreck, a death. Insurance isn't about avoiding disaster. It's about making disaster survivable by spreading its cost across everyone who didn't get unlucky this time. It's a small idea, but it's about to become one of the most powerful financial tools ever built. Jump ahead to September 1666, London. A small fire starts in a bakery on Pudding Lane. Within 4 days, it has destroyed over 13,000 houses, 87 churches, and most of the medieval city of London. Tens of thousands of people are left homeless overnight. There is no system to help them rebuild, no safety net, nothing. Out of this catastrophe, a man named Nicholas Barbon sees an opportunity and starts the first fire insurance company in history, the Fire Office, in 1667. For a fee, homeowners could insure their property against fire. If their house burned down, the company would pay to rebuild it. This wasn't charity, it was a calculated business. Barbon's firm hired the first fire brigades not out of civic duty, but because it was cheaper to put fires out than to pay for rebuilt houses. Buildings insured by his company were marked with a metal plaque, a fire mark, so the brigade knew whose house was worth saving. Read that again. In the earliest days of fire insurance, if your house wasn't insured, some brigades would let it burn. Insurance had just revealed something important about itself. It wasn't just protection, it was leverage, and leverage always comes with a hierarchy of who gets saved first. Around the same era, a coffee house opened in London, owned by a man named Edward Lloyd. Sailors, ship merchants, and ship owners gathered there to trade gossip about which ships were arriving, which had been lost, and which routes were dangerous. Lloyd started publishing this information as a newsletter. Wealthy men who frequented the coffee house realized they could use this information to make bets on ships. If a ship owner needed protection against losing a vessel, a wealthy patron could agree to cover the loss for a fee by literally writing his name underneath the risk on a piece of paper. This is where the word underwriter comes from, quite literally someone writing their name under the risk they were agreeing to take on. This coffee house became Lloyd's of London, and it grew into the most powerful insurance marketplace on earth, insuring everything from cargo ships to, centuries later, Bruce Springsteen's voice and Dolly Parton's legs. What started as gossip over coffee became a financial institution that has now insured more risk, catastrophe, and uncertainty than almost any organization in history. By the 1700s and 1800s, insurance wasn't just protecting ships and buildings anymore. It was becoming essential infrastructure for war and empire. Colonial trading companies insured their fleets before sending them across oceans to extract resources. Insurance made colonial expansion financially rational because now losing a ship to a storm or an attack wasn't a company-ending disaster, it was an insured, absorbable loss. Insurance didn't just protect wealth, it protected the machinery of empire, making risky, brutal, extractive expansion safe enough for investors to keep funding it. And there's a darker chapter here too. In the transatlantic slave trade, insurance policies were written on enslaved people as cargo, an horrifying, undeniable historical fact. The infamous Zong Massacre of 1781 involved a ship's crew throwing enslaved people overboard, partly because the ship's insurance would cover the loss of cargo, but not deaths from disease or lack of provisions. Insurance, at its worst, didn't just fail to protect human dignity, it actively created financial incentives that ignored it entirely. This is the uncomfortable truth buried in insurance's history. Any system built to protect capital without protecting the people the capital touches can be turned into something monstrous. In the 1700s, something happened that would change insurance forever. Mathematicians got involved. Life insurance had existed in crude forms for a while, but it was essentially gambling. Nobody knew how to price the risk of death accurately. Then, in 1762, the Equitable Life Assurance Society in London became the first company to use actuarial science, calculating premiums based on age, life expectancy, and mortality tables built from real population data. Suddenly, insurance wasn't guesswork, it was math, Cole's precise statistical math. An actuary could look at your age and tell you with unsettling accuracy the probability you'd be alive in 10 years, 20 years, 40 years. This turned insurance companies into some of the most data-driven organizations on the planet, centuries before data-driven was even a phrase. And it gave them an enormous advantage. They weren't betting against you, they were calculating you. The individual customer could never win this game long-term. The math was built so that across millions of people, the house always comes out ahead. That's not a flaw in insurance, it's the entire business model. By the 20th century, insurance companies had become some of the wealthiest institutions in the world, not just from premiums, but what they did with those premiums. Here's the trick. Insurance companies collect money up front long before they might ever have to pay out a claim. That means they're sitting on enormous piles of cash at any given moment, money called float. Insurers realized they could invest this float in stocks, real estate, bonds, and make enormous profits, all while still holding your premium hostage against your future disaster. This is famously the exact business model that built Warren Buffett's empire. Berkshire Hathaway isn't really a stock-picking company at its core. It's an insurance company that uses its float to buy everything else. Insurance had transformed. It was no longer just protection against disaster. It had become one of the largest, quietest sources of investment capital on the planet, funding industries, real estate, entire economies, using money that technically still belonged to millions of everyday policyholders. And then insurance did something it was never supposed to do. It almost broke the entire global economy. In the early 2000s, a company called AIG, one of the largest insurers in the world, started selling something called credit default swaps. On paper, these were insurance-like products that protected investors against mortgage defaults. But there was a critical difference. Traditional insurance is regulated. Companies are required to hold reserve in case of payout. Credit default swaps weren't regulated the same way. AIG was selling protection against a housing collapse without setting aside enough money to actually pay out if that collapse happened. Then, in 2008, the housing market collapsed. Millions of mortgages defaulted at once. AIG owed hundreds of billions of dollars it didn't have. The U.S. government had to step in with a bailout of $182 billion because AIG had become so deeply woven into the global financial system that its collapse threatened to take down banks, pensions, and economies worldwide. The industry built on calculating risk had, in its most unregulated corner, completely miscalculated the biggest risk of all, and the entire world nearly paid the price. Today, insurance is almost invisible, and that's exactly why it's so powerful. It's in your rent, baked into the landlord's costs. It's in the price of your flight, your car, your phone contract. It's the reason banks will lend you money for a house, because that house is insured. It's the reason hospitals can operate, doctors can practice, and businesses can open their doors. Nearly every major structure of modern life, home ownership, healthcare, air travel, global shipping, construction, depends on someone, somewhere, having already calculated the odds of it going wrong and agreeing to cover the cost. The global insurance industry now manages trillions of dollars in assets, more than the GDP of most countries combined. It doesn't make headlines like tech or oil. It doesn't need to. It sits quietly underneath almost everything, deciding through pricing, denial, and payout who gets protected and who doesn't. Insurance started as a way for scared merchants to protect themselves from an unpredictable world. But somewhere along the way, it became something else, an industry that doesn't just respond to risk, but actively profits from our fear of it. An industry so large and so deeply embedded that its miscalculations can crash the global economy, and its calculations can decide who receives care, who rebuilds after disaster, and who is left to face it alone. Insurance is, at its heart, a mirror. It reflects exactly how a society decides to value human life, property, and risk, because someone, somewhere, has already put a number on it. The next time you sign an insurance policy, remember, you're not just buying protection. You're placing a very old, very calculated bet, one where the house has spent 4,000 years learning exactly how to win.
If you liked this deep dive into the hidden history behind the systems that run our world, subscribe for more, because money, like everything else, has a story, and once you see it, you can't unsee it.